Hi, Ken Boy with Accounting Accidentally. This video is called Impulse Purchases, Wayfair, and Contribution Margin. So to explain what I mean by this topic is let's look at Wayfair. If you're not familiar with Wayfair, you see across the top here all the items that they sell. They're largely an online business. And you'll notice that they offer big discounts, 70% off, 70% off Black Friday. So this is an online seller of goods. So that being said, the Wall Street Journal reports Wayfair ups promotions without taking a big financial hit. Here's how they do it. It's from the Wall Street Journal. How does this mostly online bazaar pull off a steady stream of promotions, including seasonal and pop-up sales, without big dents to its income statement or balance sheet? So here's the impulse buy point. First of all, Wayfair has suppliers cover nearly all the costs tied to promotion. That's a cost they don't have to incur. Secondly, while these deals draw in shoppers, those people aren't just buying the items on sale. Importantly, they're browsing more and tacking on other products. They're going out to buy a sale item and they're buying more. In fact, revenue generated during these promotions, 70% comes from the non-promoted items, meaning those impulse buys or additional buys that they get. They get a bigger ticket and a bigger sale based on promoting just a fraction of what's actually being purchased. Why does that matter? Well, because the more revenue you produce, the more money you have available to cover fixed costs, which is going to get us into contribution margin in a minute. So there's a need to cover these fixed costs. This is Wayfair's income statement. You can see it's in thousands. You have cost of revenue, cost of sales, materials and labor related directly to the products that they sell. But you also have operating expenses. And you can see if you add two zeros on, it's in the billions. These are costs, possibly fixed costs, that they are incurring that they need to cover with revenue. And this is going to get us into the contribution margin discussion. Let's start out talking about contribution margin with this formula. Profit is sales times units sold in green, less variable costs times units sold in red, less fixed costs in brown. We can set the profit to zero to figure out break even. We can set a target net profit that I've done on other videos, which I used here as $50,000 to figure out target net profit. So you can manipulate this formula, and it can also be used to explain contribution margin. So let's assume an e-commerce business sells hiking boots, sale price 118, variable cost 78, fixed cost 150,000. We sell 5,000 units. Okay. Total sales, sale price times units sold, variable cost per unit times units sold, total variable cost, fixed costs by definition are fixed. We come down to a profit of $50,000. Now, here's contribution margin. It's sales less variable cost, and that is used to that amount, $200,000, is used to cover fixed costs, 150,000. The remainder is profit. And I can click here, and you can see how the contribution margin in blue less fixed costs in brown equal the same profit number of $50,000. And there are some strategies you could use to improve the results. You could increase the sales price per unit. Wayfair probably doesn't want to do that because they're a big discounter. They're trying to increase the units sold. They're also trying to reduce variable costs by having suppliers pay promotional costs. So all these strategies can be used to improve contribution margin, which improves profitability. So the takeaway here is that contribution margin can be changed by changing the sale price, the units sold, and variable costs to come up with a contribution margin that's larger to cover more fixed costs and to generate more profit.